Are you making really good money, but you have a lot of write-offs? Well, this is how self-employed people can get a jumbo mortgage in 2025 without perfect W-2s. So this video really is for you if A, you're self-employed, B, you've probably been told that you don't qualify for the mortgage that you want to get because somebody's looked at your tax returns and they've determined that you don't claim enough income to qualify. Or it could be for you if you're just newly self-employed or it's the first time you're buying a house as a self-employed person. There's a lot of confusion around this area, and the more calls I get as I do these videos and the more people I talk to, the more I realize that there's really not a lot of people out there that really understand how to qualify self-employed borrowers. So really, the thumbnail sketch of the borrowers I help most are people that have a company of their own. Maybe they are 100% owner of their company, or maybe they have a partner, maybe they're 50% owner of the company, making really good money, but they do have a lot of write-offs. And they're not quite sure how to prepare their tax returns to have the best chance of qualifying. Typically for these kinds of loans, if we're talking about an alternative documentation loan, is going to be a 10% down payment minimum. So a lot of times that's what I find is the stumbling block. But if you're watching this, you have plenty of money for down payment, and you're just a little confused on how to put a loan together, then that's what I'm going to talk to you about today. So the number one way as a self-employed person, and the best way to get qualified for a jumbo mortgage, is the old-fashioned way. So when you go to a bank, or I'm a mortgage broker, so I have 100 different lenders I work with, but everybody underwrites a fully documented loan the same way. You're going to have 2 years of tax returns. You're either going to have a Schedule C, which is where you only file your personal tax return, and then you have your business in it as a Schedule C, or you're going to file a separate tax return. So you'll have an 1120S tax return. So you'll have your personal return and your business return. And you're going to have at least 2 years of those. In general, the way a traditional underwriter looks at a jumbo mortgage is they take a 2-year average of your income. Now, if your income is trending up, so let's say in 2023 you had a good year, 2024 you had a better year, well then they're going to take a 2-year average of that. But if it's the opposite, and in 23 you had a better year than in 24, well they're only going to use the 24 return because that's declining income. So that's something to definitely think about. A lot of times what I see is obviously too many write-offs. So let's say you're filing 1120S, you're 100% owner of the business, and your K1 has $10,000 in income, for example. Another common mistake that I see people get is they say, well, I have a W-2. My company pays me a W-2. Well, when you're self-employed, it's not like when you work for somebody else. So the W-2 is not the only thing that's taken into account. That's just a part of your overall income. So let's say you pay yourself $100,000 as a W-2 employee. In general, you're going to add those together and you made $110,000. Also, if you have depreciation, that can be added back in. And maybe a few other things like mileage. If you're a Schedule C borrower, where you only file one tax return and you have the Schedule C in the return, then again, it's going to be the same thing. You're going to have 2 years of tax returns. Obviously, there's not going to be a W-2. So the basic math behind that is it's really an Excel spreadsheet that the underwriter fills out. They're going to look at line 31 from your Schedule C tax return. That's going to be your net profit, what you're paying tax on. And then they're going to add back depreciation, whatever in that line, and they can add back business mileage. Another thing to keep in mind is if you have a lot of write-offs as far as travel and meals, they're going to deduct that from your income. So the common problem I see, obviously, is you want to reduce as much as possible your income tax liabilities. But what happens is that also drastically cuts down the amount of home you can qualify for. So what I do a lot of times with people, I was on the phone yesterday with a guy for at least an hour on really how to file he hadn't filed his 23 or 24 tax returns, how to properly file these tax returns so he could be qualified to buy a home. And in general, you're going to either have to pay more tax so you'll have enough income to qualify, or if that doesn't work, that's when we get into the next section of this video where we talk about alternative income documentation loans. So let's say the first thing I always do is I look at people's tax returns. A lot of times people might be told they don't qualify by somebody that frankly just doesn't know what they're doing. So many times we can look at the tax returns and figure out a way to make it work. We might have to think outside the box, but sometimes we can make that work. When I've determined that there's no way to make a loan work with a normal jumbo mortgage, then we start to look at alternative income documentation loans. The first thing to remember here, again, like I said in the beginning of the video, is the minimum down payment is at least 10% down. So that's one. Two, the mortgage rates are going to typically be a little bit higher. I would say on average 1% higher. The only good thing, I guess, is there's no mortgage insurance. So you could put 10% down, have no mortgage insurance. And at the end of the day, people find it's usually better than paying taxes, right? There's a couple of different ways to get a jumbo mortgage with alternative income documentation types. The number one way that I use is bank statements. So what you're going to look at there is you're going to use the most recent 12 months of business bank statements. In general, we're going to take the 12 months of business bank statements, we're going to add up all the deposits and take an expense factor. And that's going to depend on what type of business you have. Usually the minimum is 50%. So we're going to be able to use at least 50% of your deposits as your annual income. Now, if you're, say, a solopreneur, let's say you have no employees, you work from home, maybe you're a consultant, you don't really have any overhead. Well, we might be able to take 70 or 80% of the deposits and use that as income. Another way to do it is, let's say you're a business where almost all of your deposits either go into your business account and then you're really putting most of them over in your personal account, or maybe they just all go into your personal account. Well, then we can use 12 months of personal bank statements and we can use 100% of those deposits. So either way, it's going to be 12 months of those. Another way to do it, let's say that you are a 1099 type worker. You get a 1099 for either all of your income, or maybe you get 5, 10 1099s. Doesn't really matter. That's fairly easy. We just add up all the 1099s and take 90% of that, and that's your annual income. Another way to do this is what's called an asset depletion, or maybe an asset qualifier loan. The guidelines differ on that, but this is really good for somebody that doesn't even have, well, maybe they don't even have 1 year of self-employment. Maybe you just became self-employed, but you have plenty of money. At the end of the day, a lot of these alternative income documentation loans are, about having some money. But just on average, if you have at least 125% of the amount of mortgage that you want to get, let's say you want to get $1 million mortgage, as long as you have about $1,250,000 in some sort of assets, that could be in checking, savings, retirement accounts, stocks, bonds, what have you, then there is no income. That basically is your income. And then also there's going to be a certain amount of reserves. Usually they might want to see that you have 36 or 60 months worth of whatever payments you have on your credit report in addition to the mortgage to qualify. But that's perfect for the person who has plenty of money, plenty of assets, and they just want to qualify easily. So the minimum down payment on that is usually 20%, and depending on the lender that we choose. Another way that we might be able to look at this is profit and loss statement. So there actually are programs where you can just use a 1-year profit and loss. It can be audited by either a CPA or even just a certified tax preparer. And contact me if you want the guidelines about that, but that's another way that you can qualify for a jumbo mortgage. So also we need to talk about reserves, debt to income ratio, and things like that. So any of these types of mortgages, you're going to have a certain number of months of reserves. Reserves are just mortgage payments that you have in some sort of account after closing. So on the bank statement loans, sometimes it's 3 months, sometimes it's 6 months of mortgage payments that you have in reserve after closing. Another type of mortgage that I forgot to mention is what's called a no ratio loan. So I'm going to back up just a minute. If none of these other things work, then there are mortgages where you can have no income, you don't list any income on the application, so there's no debt to income ratio. As long as you have 20% down and a good credit score and reserves, that works. So that also works on a cash out refinance. So maybe you're in a situation now where you have a ton of equity in your home, you need money. That's a great way to do that. Interest rates, maybe 9%, but if there's no other options, we use that a lot. So back to what I was talking about. On these alternative income documentation loans, also the debt to income ratio is higher than on a traditional jumbo mortgage. If you were to get a traditional jumbo mortgage using your tax returns and paychecks and all that stuff, typically you're going to be capped at about a 43% debt to income ratio. That means all of your debt, including the mortgage you have, can't exceed 43% of your before tax income. On some of these alternative income documentation loans, it almost always can go up to 50% and sometimes even up to 55%. So there is much more leniency. What I tend to find is that when we are using bank statements or some of these other documentation types, the income's not the problem because there's usually plenty of deposits into the bank account. Usually it is the down payment and the reserves. So a lot of what I do, I mentioned before, is mortgage planning. So if you're, say, looking to buy a house in 2026, you need to think about how you're going to do that. See if you need to file your taxes a different way, or just determine that you're probably never going to file your taxes to where you claim enough money to get the mortgage on the home that you really want. Then we need to figure that out too, because there's also trade line requirements. In other words, you have to have a certain number of trade lines on your credit report. Sometimes I find that people just don't use a lot of credit. So, I guess the old adage, you got to have credit to get credit. Anyway, got to make sure that you have a good enough credit score and enough trade lines. And also, as far as credit score, it's going to be dependent on how much money you have to put down. But if you have enough money to put down, maybe you have 30 or 35% to put down, you can have a 620 credit score. But if you're putting 10, 20% down, you're going to need to have at least, 20% down, probably a 680 credit score. 10% down, probably a 700 or 720 credit score. So with the mortgage planning, we also might have to do some credit planning. Maybe you just need to pay off some credit card balances to get your score up. But I would say if you need some help in any of these areas, you want to get a jumbo mortgage in 2025 or 2026, and you found this video helpful, if you know somebody that might find it helpful, please share it with them. If you found this video answered some questions you have, please click like and subscribe. And if you have any questions, put them in the comments below, or just go to my website, mortgagesbyscott.com. You can fill out a contact form, tell me what's going on. We can schedule some time to get on the phone. Or if you just want to go ahead and fill out an application, you can go to my website, again, mortgagesbyscott.com, click on apply. That application just comes to myself and my team. We always do a soft credit pull, so it won't show up as a credit pull on your credit, and we can get you headed in the right direction. Thanks for watching.